question, what if my LLC set up and my business doesn't make any sales, doesn't make any money, let's say in the first year or two? Am I still liable for estimated taxes and fees? Are there fees that I have to pay for my LLC even though it doesn't make any money? Hold up on that LLC. Did you know that even if your LLC doesn't make any money, you are still obligated to fulfill annual fees and estimated tax payments? Yes, it's true. Even if your business doesn't generate any sales or income for the first year or two, you are still obligated to fulfill some obligations. And one of them is annual fees. This is at a state level. State fees. Most states charge an annual fee or require an annual reporting to be filed, regardless of whether your business has made any money or not. These fees can range anywhere from $50 to $800 a year, and that depends on the state. And that's why some businesses strategically incorporate in states where there's no fees, there's no taxes, there's no this, there's no that. And you can do that. But if you choose a nexus state to incorporate your business, that's when you need to have a resident agent because you're not actually there. If you are incorporating in the state in which you are actually physically in, then you can have your mail and whatever you need to do come directly to your business location. So that's the purpose of that. However, if your business doesn't make any money, you're paying fees for what? Just to, for like that doesn't make any sense. So you've got the state fees, but you've also have franchise taxes, and some states also impose a franchise tax. California is one of them. Even if that LLC didn't generate any income, you have to pay a franchise tax. Even a minimal franchise tax may be charged if the LLC is active without any sales. So now that's two fees. But you also have an estimated tax payment. And this is great. No income, no estimated taxes. If the LLC has no income or very little, there may not be a requirement to pay an estimated tax to the IRS, since estimated taxes are typically based on income projections for the year. You can only project if you can see historically what you've already done. Projections are based on what you've done and projecting what you will do. Forecasts mean I just started, I haven't done anything, but I'm going to do this so I can make money. So I'm going to forecast. That's what I'm shooting for. That's what I'm forecasting for. Now, estimated tax, no income, no estimated tax. Self-employment tax, however, if the LLC is a single member, sole proprietor, and is showing profit, even without sales, self-employment tax may still be owed on any income that you've generated. So if you made zero sales but still have some business related income or draw, it might be necessary to make quarterly estimated tax payments on top of the annual fees. And it's also possible to file for a tax extension if you don't expect to owe taxes due to a lack of sales. Now I want to go back because I don't know if you quite caught what I said. I was giving you the legal jargon, but did you catch if you made zero sales but still have some business related income? Well, if you made no sales, how can you have zero related income? Oh, I'm so glad you asked. It can be a bit confusing. A business can show profit even without sales due to a few factors. Passive income or other income sources. Even if your business isn't actively selling your product or service, it might still have some income coming in from other sources. Interest. Interest income from business bank accounts and investments, rental income from property or equipment owned by the business and you're renting it out, dividends from property or equipment owned by the business, royalties if your business owns some intellectual property, trademarks, patents, copyrights. Okay, so there's a lot of other ways to make money. This is where income streams come into play. Now, you want to have these set up, but if these are passive income streams and then you're paying out these fees, then it's kind of counterproductive. These forms of passive income would show up as revenue even if you aren't actively selling those goods and services, your main goods and services yet. And because of that, you're going to have to do something about it. Business write-offs is also, everybody gets excited about, I'll take the check and I can write it off. Sometimes a business might not generate income from sales, but it could still show a profit due to the way expenses are handled. And I will say it again. This is why it's important to set up your books from the moment you open your doors and are in business. Your books should already be set up. Don't wait until you hit a financial milestone or until you can hire an employee or until there are so many other options to managing your books that you really need to consider. Depreciation. If you've purchased equipment, something expensive, vehicles, other assets for your business, you can depreciate that value over time. Generally, your bookkeeper may not do it, but your accountant may. And that's something that the bookkeeper would pass on to the CPA to do for you. But this means that you're recording a portion of the asset's cost as an expense each year until it zeroes out. So if you bought something for $50,000, it has a life. Like food has a shelf life. We have lives. Businesses have lives. Your products and services have a life. At some point, nobody wants to buy it anymore or you got to upgrade it. Everything has a life cycle. And so does assets. If you bought something today for $50,000, financially, it's only going to be worth $50,000 for so long, for so many years. 1 year, 5 years, 10 years. The IRS decides what that is, right? And that means that every year, that $50,000 loses its value. It loses its value. It loses its value. So if you bought something for $50,000 and it has a life of 5 years, that means from today to 5 years from now, when it hits 5 years, it's worth zero. You can't write it off, nothing. Now you could sell it if it's worth selling, whatever that is. But as far as documenting that financially, it's worth nothing. So depreciation will show that value of the asset over time, but this means you're recording that portion of the asset's cost as an expense every year to reduce it, reduce it, reduce it. And even if no sales are happening, reducing it and depreciation, reducing that, your overall taxable income is what it's doing. You haven't made any money, or let's say you made 1,000, but your depreciation is 5,000. Well, it looks like you just made $4,000, but you didn't. It's the numbers game, right? That taxable income sometimes gives the appearance of a profit when you actually didn't sell a damn thing. Tax credits and deductions are another issue. Some businesses might have tax credits, some have deductions, and that lowers your taxable income and results in you getting a tax refund. But research and development credits, energy efficient deductions, all of these types of things can lead to positive financial results when you actually didn't sell anything. Loans and capital contributions. If your business receives a loan, capital contribution from owners and investors, They've invested capital into your business, and all of a sudden you've got $50,000. Okay, you didn't sell anything. It's a capital contribution. This is again why your books are important. So you can record it the right way and you can take any tax benefits properly. Now that you have this capital contribution, this money would show up on the balance sheet as cash. 50,000, where did it come from? While this isn't income because you didn't sell anything, it can make the business appear to be profitable. You didn't have any money last month. You got $50,000 this month. You made some money. So, in short, the term increases your cash flow, even though it wasn't a sale. For example, if a business receives a loan, personal contribution, they might have enough capital to cover their expenses, but no sales have been made. Profit from bartering and non cash transactions. Some businesses engage in bartering instead of making direct sales. If a business exchanges services or products with another business, they might recognize some income even though there's no actual money exchanged. So if you barter and you give them services and they give you something physical, that something physical may be of value, of current value. You say, okay, well, I don't have any money, but I need this vehicle for my business. So what I'll do is I'll do bookkeeping services for you. I'll do consulting services for you, non-tangible services in exchange for that car. Okay, well, give me 6 months of services and I'll give you the car. And when you exchange and give them services, they give you the car. You may look at the blue book and that car may be worth $50,000. That goes on your books as $50,000 because it's an asset. And because you need, now, why somebody would make that exchange is irrelevant. The fact is, it happened. And that's how you record those types of transactions. And that's one of the ways that you cannot make any sales and appear to be profitable and have to pay taxes on that as well. Um, it's also the reason why you'll see like game shows. It's great to win a new car, and and guess what? Now you have an asset, and you got to pay taxes on that car. Whatever your state deems happens when you own a car. So now you have to account for that. Accounting methods, your accrual accounting. Cash accounting is usually like a candy store or whatever. But so generally you're operating under an accrual. You don't have to be, but probably are. And revenue is recognized when it's actually earned, not when the payment is received. So if I do business with you today and you owe me $50,000, that goes on my books as accounts receivable. It's on your books because you provided the service, you had costs, and you issued a bill and said you owe me. So it goes on your books. Now, even if you don't have cash flow or sales, you might have a profit on paper and you've earned income even if you haven't collected the money. So let's say you start a business, but the first year you don't make any sales. However, you invested in some equipment, you have a loan from the bank that's been recorded as what is actually a liability, but the offset is the capital. And it's going to cover some initial expenses. In this case, your business could have expenses like depreciation for that equipment or even interest expense on that loan. And those could result in tax deductions that lowers your net income. You didn't really make $1,000. You only made $500 because those expenses are offsetting your income and lowering it so that you pay on the bottom line, showing that you have a profit despite you don't have any revenue. That's how it happens. So a business can show a profit even without sales by having non-sales income, expenses that reduce taxable income, capital infusions. You got a loan from your rich uncle or whatever the case may be that keeps the business running short term. However, actual profits in terms of growth typically come from sales and business operations because you had a minimal cost and you sold it at a price that gave you a profit. These are things that you really, really need to understand. Now, if you are just craving more interaction and support from like-minded entrepreneurs, the No Boss Hubs are the place to be. And it provides that ongoing guidance and that community to help you stay on track. Whether you need help with your business foundation, marketing, managing multiple income streams, questions, customizing certain things to fit your business, that's what No Boss is all about. Because success starts with you, and No Boss just helps you get there. Thank you for watching, and I'll see you in the next video.